Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can find me on Twitter at XBorderTax. On this week's episode of Cross-Border Tax Talks, I'm excited to be joined by Ninee Dewar. Ninee is an international tax partner in our Washington National Tax Services practice and a member of our National Integrated Global Structuring team. Before joining our WNTS practice, Ninee practiced in our New York City office. Ninee, welcome to the podcast.
Hi, Doug. Thanks for having me.
Well, Ninee, before we get into the FDII or Foreign Derived Intangible Income final regulations that we got not too long ago, there are a number of our partners that are either University of Michigan or Ohio State. Obviously, I'm a University of Missouri guy, but we seem to have had a disproportionate amount of Michigan and Ohio State alum on the Cross-Border Tax Talks podcast. So before we begin, I'm very interested to know, Ninee, who is your favorite celebrity University of Michigan alumni? And I did some pretty important research prior to this discussion, and I can even make it a multiple choice for you. We have Madonna, Iggy Pop, Lucy
I didn't know
Liu.
she went to Michigan.
Yeah, so either did I. Apparently, Madonna did not graduate, but she did spend some time at the University of Michigan. So we've got Iggy Pop, Lucy Liu, Tom Brady, or James Earl Jones.
Oh, my husband supports the Jets, and so I can't say Brady. So I think it might be
Understandably. All right, Lucy Liu. I'm going to go with somebody who wasn't on the list, Gilda Radner. I didn't realize was an alum of the University of Michigan. I'm a huge old school Saturday Night Live fan, so I'm going to say that my favorite University of Michigan alum, Gilda Radner. All right, well, let's dive into what we're really here to talk about, which is cross-border tax. So on July 9th, 2020, Treasury published another 295 pages of final regulations addressing the deduction for foreign derived intangible income. Ninee, before we dive into some of the minutia of these final regulations and how they differ from the proposed regulations, can you remind our listeners what is Section 250 and the FDII, or Foreign Derived Intangible Income?
Yeah, sure. So Section 250 deduction is the provision that gives additional deduction for basically two types of income: the GILTI, Global Intangible Low Tax Income, and the FDII, or Foreign Derived Deduction in Foreign Derived Intangible Income. And so if you think about the 250 deduction, the way it operates is you take into account the whole amount of the income, but then you get a deduction at a certain percentage. So it's 50% for GILTI, which means that the effective tax rate for GILTI income is 10.5%. And then you get 37.5% deduction for FDII, which means you are taxed effectively at 13.125%. And the way these two rules actually operate, and you think about GILTI maybe as the stick and the FDII as the carrot that comes in as part of tax reform, is GILTI, while the effective tax rate is 10.5%, you only allow 80% of the foreign tax credit. So when you think about that, if you pay 13.125 of tax in the local jurisdiction and you get 80% of tax, 80% of 13.125 is 10.5. You're not going to pay incremental tax in the US, leaving aside expense allocation. And that's why the rate is not, just random. The rate is specifically done to create a parity in a way between GILTI and FDII, where you can earn income in the US and you pay tax at 13.125, or you can earn income in the foreign jurisdiction, pay tax at 13.125, you effectively not incur additional US tax. So that's the parity, and that's the rule about 250. And FDII, the carrot side of the tax reform provision here, is essentially allowing a U.S. corporation to obtain this deduction and therefore getting to a special tax rate when it provides services or makes sales to foreign person for foreign use. And that's sort of the basic premise of how you get into FDII.
Yeah, and the way I think about it, Ninee, if we go back to, I mean, all the way back to the Chairman Camp proposal, however many years ago, when they, this kind of system got introduced, the idea, to your point, you called it the carrot and the stick, was to not to have a tax system that didn't incentivize or disincentivize the movement, if you will, of intellectual property outside the U.S. So that, at least the way I think about it broadly, is that they didn't want to create, the Congress didn't want to create an incentive to move IP outside the U.S., which arguably existed pre-tax reform, where companies were deferred from U.S. tax until they brought those earnings back, as opposed to now under the new system, if you keep the IP onshore, theoretically, if you meet the requirements, it could be subject to FDII, and you'd get the Section 250 deduction to be taxed at an effective rate, federally speaking, at 13.125. Or even if you moved it offshore and you did pay some foreign tax credits, that generally the effective rate would be 13.125, so that there was some parity. But as we've learned and as we know, obviously the income is that is potentially subject to tax for this preferential regime under FDII is more than just kind of pure royalty income or pure intangible income. And so the statute is generally very broad, and the Congress gave Treasury really, really broad authority to develop regulations on actually how to apply these rules. And so in March of 2019, we ended up with some proposed rules that provided a whole bunch of guidance on this, including ordering rules for interest expense under 163J, the NOL rules under Section 172 and 250, because all of those provisions require you to start with taxable income. And it's like, well, which one comes first? There were some very specific rules on how sales are divided between general sales and intangible property sales. There were 5 categories of services income that were developed: transportation, property services, proximate services, general services provided to consumers, and general services provided to business recipients. And then there were some very arguably draconian documentation requirements with respect to establish a sale was to a foreign person for a foreign use. And then also business recipients of general services are outside the U.S. and how that's documented. And then a number of other rules, which we'll touch on a couple, for sales and services provided to related parties. And so the final regulations that came out really addressed, and I think this, Ninee, has been a common theme of these regulations, where Treasury is really listening to taxpayers, advisors, various stakeholders, professors. There were a lot of comments received, particularly on the documentation requirements. But maybe before we dive in, I know the documentation has been probably the hottest issue, but any just broad comments as you've digested the final rules compared to the proposed rules, any just broad trends that you're seeing?
I think overall it's positive in the sense that the proposed regs provided a lot of guidance, but there's still a lot of sort of open, unclear matters that I think are addressed in the final regs. So there are a lot of helpful clarification and also specific provisions. And to your point, Doug, probably the biggest thing is the documentation substantiation point.
So let's go there, Ninee, because that's where I think a lot of taxpayers and just a lot of comments and concerns with respect to documentation. And I think that really one of the challenging things with the proposed regulations was the potential need to be able to get documentation from third parties, and the fact that some of the requirements could actually impact commercial transactions as far as long-term contracts versus annual contracts. So tell us a little about what are some of those important changes with respect to the documentation rules. And I think one thing that I'll remind listeners is that these rules get mind-numbingly complex depending on which category of transaction you're into. And we're not going to dive into each of the respective transactions, but there are some very, very specific rules still. But talk a little bit about those documentation rules, Ninee.
Yeah, so I think the proposed regs were providing the documentation rule as substantive rule, right? You actually do not get any FDII benefit if you fail the documentation requirements, and they're very specific, and taxpayers are kind of wondering how they can achieve or meet those requirements, which, to your point, some of which would require information from third party or changing the contracts with third party to allow them to have access to the information. So the way the final regulations handle this is they obviously got a lot of comments from taxpayers and professional firms and advisors and things like that. So now it becomes a substantiation point where there's no specific documentation requirements anymore, but taxpayers would have to follow the normal substantiation rule under 6001, apart from certain specific categories where there will still continue to be some specific requirements. But again, the rules are relaxed such that the information that is required is going to be a lot less burdensome to the taxpayer.
So what does that mean? Like what does substantiation mean? And what advice would you give for taxpayers with respect to thinking about these final regulations?
I mean, I think it still comes back to your point earlier. There are multiple categories of sales and services and various buckets, and so you still have to make sure you understand what bucket of transaction you fall under in order to figure out whether there's a specific substantiation requirement and go from there. But it also means that you can make sure that the system will allow you to have the necessary information to meet the substantiation requirement. But again, I think the relaxation of the rules means that certain things you probably will have already as part of your normal business dealing, which is a welcoming change.
Yeah, so I think that the approach then for taxpayers becomes less of well, what do we need to do in the market with some of our customers or clients to the extent that's providing services to be able to substantiate that or to be able to get that documentation versus what information do we have currently within within our business our processes and systems to be able to document that substantiation. And obviously not having to go to a third party, particularly one that you're negotiating with for a sale or service or whatever the case may be, is obviously very preferred than potentially having to impact the transaction or the sale because it would enter those negotiations.
Right. And I think that the government kind of acknowledged that some of the previous documentation requirements basically would require information that taxpayers normally wouldn't get. And, in the competitive environment, you're not going to get that from the third party. And so I think it becomes more manageable for taxpayers.
Yeah. And I can certainly understand Treasury's challenge, right, and where they started, because this is obviously a regime that can be very beneficial, moving from the 21% rate down to the 13.125. So Treasury had to balance the desire, right, to be able to afford the deduction to taxpayers, create some guidance, but also limit and the number of transactions that would be potentially subject to this beneficial regime. And I think that at least my 2 cents is that I'm not sure that they got that balance right in the proposed regulations, but on the final regulations, I think we're still digesting, but it seems to really be a more balanced approach for companies to be able to substantiate. The other thing that I would note is that, and this is just one example that of kind of the relaxed view that Treasury is taking, is that in certain situations, depending particularly if there's a lot of volume of transactions that may not be able to be substantiated, that statistical sampling, for example, this was mentioned in the preamble, like something like that could be considered to help with substantiation.
Yep, that's right.
So I know that there were also, there's some questions, Ninee, and relates to the documentation, but for lost transactions, and how did that change in the final regulations?
Yeah, so I think in the proposed regs, because the documentation is the substantive rule, you don't have it, then you can, flunk out of FDII. So the government at the time was worried about people using failing the documentation to take out the lost transaction to not have to cover it included in the FDII calculation and reduce the benefit. So now that we have changed to the substantiation requirements, that rule is still there where you still, can't really get out with just not having the substantiation. But again, the threshold is different. But again, the Treasury is still trying to make sure that taxpayers are not playing games by intentionally doing something so that they can get the better benefit from excluding certain lost transactions.
So let's move then to the calculation of the deduction, because this is something that we've spent a lot of time thinking about and trying to understand for taxpayers. So some of the different provisions that rely on taxable income, either as a starting point or as a base in the calculation, is 163, all of which we've covered a lot of on cross-border tax talks, is the 163J, so our interest limitations, the section 172, which is generally the net operating loss carry forward and carry back provisions, and then section 250, which obviously both relates to our FDII as well as GILTI. So can you set the table a little bit on those computations and what the original proposed regs say, and ultimately now what the final rules tell us?
Yeah, so the proposed regs provided a 5-step ordering rule in terms of how you take into account the limit under 163J, the 172 deduction. You have to calculate tentative section 250 deduction. And this is all the ordering rule for purposes of calculating the taxable income limit. Because I guess we didn't mention this earlier, that the deduction under Section 250 is subject to a taxable income limit. So in calculating whether you're going to get the full 37.5% deduction, you have to go through the taxable income limit consideration. And the ordering rule basically just give you the 5 steps how you get there. And the change in the final regs basically provide that they're going to reserve on the interaction of all these provisions, because they think additional guidance will be in order, but they want to think more about it. And so during this time, taxpayer can basically use any reasonable method, which includes the method that was provided in the proposed regs. And there's some comments around, doing a concurrent calculation, but then it makes the computation perhaps maybe more complex. And so the government is studying that, but at least the provision is reserved for now, and taxpayers can choose to apply, the method under the proposed regs as one of the reasonable methods to use.
Yeah, and I think that obviously anytime the Treasury tells us that we can do any reasonable method, I think what that means for taxpayers as well as advisors is to say, okay, well then we need to look at what are the various types of reasonable methods and then pick which is the one that is the most advantageous to that particular taxpayer. And so I know that's something that we've been thinking about. I've been thinking about as a challenge to, all right, well, when you're creating the model and you're trying to develop and understand how does that computation work, it certainly creates additional complexity with respect to, okay, what are a variety of different reasonable methods, applying the calculation against that reasonable method, and then picking that best method. And I think that generally speaking, taxpayers would say, well, that's great, because we can pick what's best. But I think the other side of that coin is that it just creates additional complexity for taxpayers to think through the variety of different reasonable methods, and then whatever modeling tool they might be using, being able to adapt that to be able to determine what is the best reasonable method.
That's a really good point, Doug, that, when we'll probably touch upon this later about applicability of these rules, but the modeling is so important to try to figure out what rules you want to apply when you still have the options to, whether apply the proposed regs or just rely on the statutory language or pick and choose and things like that. So it all comes down to how it impacts you overall, taking into account all the changes.
Yeah, that is a constant theme, Ninee. Whenever it seems like whenever we're talking about U.S. tax reform, that like we mention modeling so much, and it really becomes so important, particularly as there are various levers that can be pulled by taxpayers within these regulations. One other thing before we move on with respect to the ordering rules, which you mentioned, which I think is really important for taxpayers to remember, is that Section 250 in general, so the ability that allows us to get a deduction on our foreign derived intangible income as well as our GILTI, is taxable income limited. And so it's really important for taxpayers to remember, particularly given the economic environment that we're in and a number of companies that are looking at net operating losses, particularly maybe where they haven't been in the past because the economy had been so much stronger historically. But if a company is in a net operating loss position, they don't get the 250 deduction. And so taxpayers who are in that position effectively are taking an item of income, if you've got FDII eligible income that would otherwise be subject to tax at 13.125. Well, if you don't get the 250 deduction, effectively your net operating loss is offsetting an item of income that, if you were in a taxable income, should have been subject to tax at 13.125. And I think it's just a mechanic. It's just the way the mechanical rules work, and the fact that Section 250 is a taxable income deduction. But it's really important for both taxpayers who have GILTI, as well as taxpayers who have potentially FDII, to be mindful that if you do tip into an NOL, you're effectively using a 21% attribute to offset what should otherwise be 13.125, or frankly, even now with the CARES Act, which we've talked about, you might be using a 35% attribute if you could otherwise reduce that. You could otherwise take that NOL and reduce pre-tax reform taxable income, which was subject to tax at 35%.
Absolutely. And I think to remind everyone that the NOL we're talking about here is, include it for taxable income limit. It includes the carry forward NOL, which is the thing that you should make a distinction on, where you are thinking about NOL and carry forward NOL for purposes of allocating and apportioning expense to, FDII. Because in that case, the proposed regs didn't provide specific rules around whether these previous NOLs would be taken into account, or the pre-reform NOL would be taken into account. And the final regs actually provide specific rules on this, which is to say that the prior NOL won't be, the carry forward NOL won't be taken into account in allocating the expense, which I think it's helpful from that perspective. So the general theme of the 250 deduction calculation, which is mentioned throughout the preamble, is that it's the current year calculation. So a lot of the deduction that is actually taken into account in arriving at the amount of the deduction that is the income that is eligible, and the deduction that is eligible is going to be based on the expense for the year, and not expense from other year, and it won't take into account the sort of limits that may be imposed by some other provisions.
I think that was a helpful clarification, or helpful rule that was added in those in those final regs. So a couple of other items want to cover that I think are relevant to a number of listeners. First of all, one of the clarifications, or I guess additional guidance that we got in the final regs compared to the proposed regs, involved digital content. So really an expansion of the FDII sales and services rules to address additional types of transactions, so really specifically electronically supplied services and advertising services. So can you talk about that? Because there were quite a few comments that were received with respect to particularly digital taxpayers who have services or advertising services.
Yeah, so I think that this is a helpful clarification, and the move on Treasury's part about acknowledging that in this environment there are so many things that are delivered electronically, and the government issued the cloud REGS last year, proposed REGS last year, and so this is kind of consistent in the theme in that there are now specific rules for the digital content transactions that are specifically addressed, as well as to your point, the advertising transactions. So the digital content, the measurement is now they're going to look at where the user is downloading the content as the place of use. And advertisement income, you can look to where the advertisement would be aired, essentially, if they're aired over the internet. And so I think it's very helpful for taxpayers in those industries that they will have specific clarification on these points. And the other thing is there was an example in the proposed regs around copyrighted article that was suggesting that maybe that was included in the intangible, the transaction, as opposed to general property. And so the regs also clarified the example and make sure that if it's a copyrighted article transaction, then it's actually a general property and not intangible property transaction.
All right. So one of the other rules that I know had some controversy in the proposed regs that was changed was with respect to related party sales. The proposed regulations would have required effectively an amended return if a third party sale happened in the tax year. So I think the way the proposed rule had operated, that if a U.S. corporation sold to a foreign related party, and then that to be able to avail for the U.S. taxpayer to avail itself of FDII, it would have needed to be able to establish that that foreign related party either sold or provided that service within that same taxable year. And if they had not done that, then they wouldn't otherwise be eligible. But if they did it in the next taxable year, then I think it would have generally required an amended return to be able to qualify that income for FDII. And fortunately, there were a number of comments on that. Fortunately, they changed that rule as well.
Yeah, so that's another helpful change where you don't need to file an amended return anymore. So the final regs basically allow taxpayer to treat the related party sale as eligible transaction in the tax year that the related party sale occurs, as long as the third party transaction occurs in the ordinary course of business. So even if it's not done by the time the return is filed, as long as it's customary in the ordinary course, then you can claim FDII in that year.
Yeah, then there was also a rule, Ninee, that there was effectively like a cliff that was put in that you needed to have, I think, 80% of your revenue from unrelated transactions. And I think now they've changed it to ratable. I know that was another one on the related party transactions that was a little sticky.
That's right. So again, helpful to, rather than providing a cliff effect, you can just get pro rata. So if you are just short of 80, you can still get the benefit to that extent. And also some rules around intermediate, like a sale to U.S. related person, that in specific circumstances, you could still qualify for FDII. Because typically, like the related party sales talks about the sale through related party that is a foreign person, but in specific circumstances, a transaction through a U.S. related person could still be eligible.
Right. So again, we're just kind of picking and choosing some various rules in those final regulations. A lot of detail in that, particularly with the documentation. So, Ninee, maybe we close here talking about effective dates and applicability. And frankly, I still get my, wrapped up in a pretzel on applying proposed regs versus applying the final regulations. And there was some flexibility with respect to these effective dates. And can you talk about that? And I mean, we've got just myriad of different rules, and we've obviously for a number of our clients and taxpayers have spent a lot of time thinking about the proposed regs, and we were going to apply that, and even from an accounting standard, and now we got to think about the final regulations. How does all that stuff piece together, Ninee?
Yeah, so the final regs will be effective for taxable year beginning after January 1, 2021. So basically, that the preamble states that they want to make sure that taxpayers have 3 years of transition, and during that transition period, they can either adopt the final regs in its entirety, or they can rely on the proposed regs. But even if they picked the proposed regs, the documentation, the strict documentation rules won't apply, and they can apply the transition rules for documentation under the proposed regs for it's basically this whole transition period, as opposed to just the period that the proposed regs originally provided before it came out. So I think effectively final regs won't apply until 2021, and the periods before that, taxpayers have some flexibility to try to figure out which they want to apply. I think one interesting thing that I was thinking about is around the fact that the requirement of the effective date or the requirement to apply the proposed regs talk about applying it in its entirety. So there's a question of, does that mean it has to be applied consistently year to year, or can we, apply proposed reg 1 year in 18 and then, final regs in 19 or something like that? So something that we're thinking about still. And then also there's another aspect of it on the transition rule, as taxpayer can also elect to not apply the proposed regs and just do transactions or analyze the transactions based on just the language of the statutory provision, because there's no effective final reg. So some options there. And to your earlier point, it becomes maybe modeling exercise and seeing what would be most beneficial to the companies.
Right, absolutely. It's a combination of a modeling exercise, and then obviously with respect to the documentation, what information is available, and it's really going to depend obviously on the industry and the company, and they'll be able to extract particularly certain types of systems information, and can certainly be much more complicated in some industries compared to others. I do think that the broad theme though is that Treasury recognizes that this is a just massive change in the type of information that a company would normally collect and need to be able to do this type of computation. And it seems that they went to great lengths to try to create some flexibility and try to allow some reasonableness for taxpayers with respect to the transition as well as moving forward, which I think is very helpful. So, Ninee, any closing statements or anything else that we may have missed with respect to these final Section 250 regulations?
Well, I mean, I think that, it's a big package. There's a lot of details. So I think, it's time to kind of go back and really analyze all the transactions, which category you fall in, what substantiation is required, because before we got the final regs, a lot of people are kind of waiting to see if there's going to be changes, if how to decide on what to do, and now we have the rules, so it's time to really go back and scrub and see how much you already have, how much you need to get in order to maximize the benefit.
Yeah, that's a great way to wrap things up, Ninee, because it's not just obviously the regulations that companies were waiting for. Obviously, the current economic environment as well as the trade wars that are existing. I think a lot of companies are looking at their supply chains from an operational perspective, and then as companies think about changing their supply chain, making sure that they've got the appropriate documentation and systems that's also consistent with what they need to be able to maximize or avail themselves of the Section 250 deduction is really important. And so I think it's really a confluence of the U.S. tax reform changes and then what we're seeing from just a global economic and trade perspective that's really going to drive some change in this area. So, well, I think we're going to leave it at that, Ninee. So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you to Ninee Dewar for joining us on this week's episode. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in another 2 weeks for another exciting edition of the Cross Border Tax Talks podcast.